Hello everyone, this is Ashish with Investor Friendly CPA, and I think what I'm talking about today applies to every single taxpayer because you will eventually own a house. What I'm talking about is when you sell your house, what can you do? Because if you are more into real estate and you want to keep the property for rental property, you need to understand what I'm talking about because it really saves taxes. So everyone knows that when you sell your property, you don't pay taxes up to a certain amount. For married, filing jointly, it's $500,000, right? So if your property has appreciated $500,000, then you can avoid that if you live in the property for 2 years out of last 5 years. Now, I'm not going to go into that rule. This is on top of that, okay? Now, we're going to talk about how can you keep the property and then also get the benefit of appreciation and also cash flow without paying in taxes, actually saving more taxes. So let me share my screen here. I show this to everyone. This is our tax planning module where we talk about a bunch of stuff. What we are covering today is selling your primary residence to your S-Corporation, okay? So let me walk you through this. Give me a second here. So let's just over the issue. You have appreciated property, primary residence, that you want to rent out after moving out because you have a low interest rate. Cash flows are great because you bought it as a primary residence. It was low down payment and right market, everything, all those things. There are two things you can do. Let's say you move out, actually rent it out. If you sell it within 3 years of moving out, you still don't have to pay tax on that $500,000 appreciation. And I will walk you through that number in the next few minutes. But what happens if you want to keep the property, right? You don't want to sell it because you can only get exclusion if you sell it within the 3 years of moving out. But if you want to keep the property and still want to enjoy cash flow and a good interest rate, so this is what I'm talking about, and it's better. And there's it's basically double dipping. Okay, that's a good thing. Let me just give you the numbers. So let's say you bought a property for $250,000, and then the market value at the end of 5 years that you want to sell is $750,000. So you have $500,000 appreciation. If you want to keep the property and then not do what I say, then you're losing out on this benefit. Almost $250,000 of benefit, guys. You're losing out. But if you actually do what I'm saying, you're keeping that much money. Let's see how. First of all, if you really wanted to keep the property, but you end up selling after 5 years, then you're going to have to pay this tax. So why can't you sell this to your own S-Corporations within time frame and then save this much tax first? And on top of that, when you sell this to your own S-Corporation, the S-Corporation gets something called step-up basis. The property actually gets step-up basis. And you get extra depreciation. This is $750,000 new cost basis for your S-Corporation. It was originally $250,000, so extra depreciation is going to be $18,000. In the marginal tax rate for this taxpayer, which happens to be me, let's say it's 25, state and federal, not that high, right? You're saving $126,000 in taxes over the life of this property. Per year you're saving around $4,000, but unless you keep it the property for the whole time, that's $126,000. So even without time value of money, we're talking about $250,000 tax savings by doing what I'm saying. So you keep the property and sell it to your own S-Corporation within the time frame, right? The biggest concern people have is this, which is a true concern. It says, so remember what happens is when you keep the property in your own name, not in S-Corporation, what happens is when you die, your children, your heirs get the step-up basis. Meaning, if this $750,000 property appreciated to $2 million when you die, it's in 30 years, whoever gets the property will not pay any taxes on the appreciation from this $750,000 to $2 million. However, if you put the property in S-Corporation, there's no step-up basis on the property. Meaning, when you die, your heirs will not get the step-up basis up to $2 million on that $750,000. If you follow what I'm saying, they will end up paying exact same tax as if this was not an S-Corporation. We are addressing this concern. Okay? Again, you can pause and read this. I'm not going to read this, but this is how it works. If it's this too much, if you have understood the concept, you can stop this. But if you want to know the math, how this works, when S-Corp, eventually how your heir pays, there's no tax impact, you can keep on watching this. Okay? What I'm talking about is, this is what happens. Look at this. Actual cost basis was $250,000. Selling price to the US Corporation was $750,000. We talk about this. Now, your S-Corp basis in the house is $750,000. Remember, that's how the S-Corp bought it for. The cost basis of the share, remember you're creating an S-Corporation. your basis in the S-Corp is also 750. Everyone understand this. Let's say when you die, this house appreciates to $2 million, right? So what is the fair market value of the S-Corp share at the time of death? $2 million. Makes sense. Your children will inherit your stocks. They're not inherited your property directly, inherited stock. So they will inherit a stock at $2 million value because that's how much it's valued for. Everything makes sense so far, right? Let's see what happens. When the S-Corp sells this property, it's going to sell for $2 million. Its basis, when you originally as a taxpayer sold it, was $750. So your gain is $1.2 million. We're trying to avoid that $1.2 million gain on sale. Again, if this was in your personal name, there would not be any gain because the basis would have been step up. But that's not happening right now. How this solves itself? This is how it solves itself. The shareholder basis in the S-Corp is $2 million because that's what you died with. The gain the S-Corp recognized when the S-Corp sold the property is 1.2. So the actual basis in the S-Corp is $3.2 million. Now your heir will liquidate your S-Corporation. They don't need that anymore. They're going to sell the property, right? So distribution of sale is going to be around $2 million. You're only going to have a cash of $2 million. But the actual basis in the property is $3.2 million in the S-Corp. So that there's a loss of $1.2 million. So $1.2 million netted with $1.2 million capital gain, they are both capital in nature, is zero. There's no taxable impact. Meaning you can still sell the property to an S-Corporation, still get the step-up basis that you normally get without an S-Corporation, even if you do this strategy. Okay? So I know if it sounds complicated, it is complicated. You will talk to an advisor, but I want to really put this out there. If you really want to have a right strategy for your primary residence, think about this, okay? Select your own S-Corporation, understand the other rules, and you'll be fine. If you want to see more of these videos, guys, please, we share all of these in all our platforms. Choose one and follow us, and you'll do great. Thank you.